6 stocks to buy, February 2026. Welcome back, everyone. In today's video, I'm going to be covering my favorite long-term stocks to buy and hold this month. I view each of these stocks as incredibly high-quality companies that I expect to compound for years. I'm not looking for a company that'll perform in the next 3 to 6 months. I'm looking for companies that are going to perform 5 years down the road. I think each of these 6 companies present their own unique opportunities. So let's get right into the first stock. The first stock I'm buying this month is Adobe. Now, it is no secret that this stock has underperformed. Over the past 5 years, Adobe is down over 37%. Last year alone is down 33%, and year to date in just a month is down 12%. Now, all while the stock has been destroyed the past 5 years, revenue has grown at a consistent 10% pace over the past few years, and over the past 5 years, it's grown 13% year over year. And this company is trading at its decade low valuation. Now, the number one bear case for Adobe, and actually most software as a service companies, is the threat of AI. Specifically for Adobe, it's that if generative AI is becoming so good at generating pictures for you, editing pictures, editing videos for you, then what's the point of paying for an Adobe subscription? Now, to dive into this, I think there are 2 main things you need to know. The first one is just understanding what Adobe actually is, and the second one is where does Adobe's revenue actually come from? Who are the true customers of Adobe? Now, what Adobe is it is an ecosystem of apps to help creators create. We're talking about some of the most popular creative apps like Acrobat Pro, Photoshop, Premiere Pro, Illustrator. There's obviously the Creative Cloud. We have Adobe Express. We have Adobe Firefly. The list goes on and on. They have over 50 plus apps integrated into their ecosystem to help creatives do their work. Adobe is the go-to place for creators to Photoshop something, edit pictures, generate pictures, edit videos. They obviously have the PDF. Adobe offers the best-in-class tools. So that's what Adobe is. They're an ecosystem of apps to help creators create. Now, the second part of this is, who are the true customers of Adobe? Where does the revenue actually come from? I think the answer to this question might be even more important than the first question. 80 to 90% of Adobe's revenue comes from professionals. When I say professionals, I mean professionals working at a small marketing agency. It might be a mid-sized business, or companies as big as a Nike, a Disney, a Coca-Cola. These are people who use Adobe for their everyday job. These are people using Adobe 5 days a week for hours each and every day, working as a team to complete projects. 80 to 90% of the revenue isn't coming from amateurs like me, a small YouTuber that needs to create thumbnails or edit videos. It's coming from people that need the best products in the world. Something else these professionals need is control. They need maximum control over their work. So why do I bring this up? Because AI doesn't offer that control. When you're working with AI, when you're trying to generate a picture and edit it, something is always slightly off. So for example, you're trying to generate a flyer. On this flyer, you might want it to be a red color. You might want the font in the middle. You might want some designs. When you generate it, something is always going to be slightly off. That font might be slightly off to the right. That red color might be too dark, might be too light. It might be slightly pink, or those designs are off. When you reprompt it, it's starting over fresh. So you're no longer getting that same thing. That font might move back to the middle, but then that color is slightly off still, or the designs are slightly off. Something is always wrong. And when you're a professional working for these companies, you can't afford that. You need pixel perfect control. You need to control every single aspect of the work. The key point is AI does not offer what these professionals need. It might offer what I need. I don't need something to be absolutely perfect. But if you're a Disney, a Nike, a Coca-Cola, you need to have final say. You need to have final say in the final 5 to 10% of your work. Now, these companies know that. I want to use this graphic from Jimmy Investor, his Substack on Adobe. So I'm going to put that in the link in the description so you can go support him too. But he lays out that AI models have actually partnered alongside Adobe. So when you open up an Adobe, you could generate pictures using these models and then have the world-class software interface like Photoshop combined with the AI models. So not only can you generate pictures with the top AI models in the world, you also have the best Photoshop in the world pair alongside it. So to name a few, you have Google, so you have Gemini, you have Nano Pro, you have OpenAI, so you have ChatGPT, you have Runway, Black Forest Labs, Luma AI, 11 Labs, Ideogram. You have the best generative AI in the world partnered up with Adobe. And it just makes a lot more sense both ways for this. So think, these companies give their AI models to Adobe, and they let Adobe handle the enterprise relationships, the product user experience, the distribution, and they don't have to spend tens of billions of dollars of trying to compete with Adobe, who has insane switching costs. Now, to not only tell you about Adobe, I want to show you some examples of what their AI has done, because not only have they paired up with different AI models, they also have their own, and they have done some incredible innovations. I'm going to use this X post from this account right here. So this one right here shows how you could adjust the lighting in a picture. As he moves his cursor around, it gives light from different areas, changes the shadows. I think this is just incredible. This is awesome. This next one, they're turning a 2D picture into a 3D picture, and they're able to move around the two people and make them face the other way. This one, they're showing that you could edit what a person is saying and keep the same voice consistent. This one is showing you could add, remove, and edit things inside a video. So in general, while people think Adobe is being taken over by AI, they're actually innovating like no one else in the industry and giving these professionals exactly what they need: maximum control with the best tools in the world. Adobe is not being taken over by AI. They are becoming the world-class AI inside the industry. Now, for my price prediction in the future, I think earnings per share is going to grow at about a 15 to 16% pace. So I'm going to use 15 for this. And then I think the multiple, the EPS multiple, will be anywhere from a 25 to 30. If we want to use 25 for that, at today's prices, we could expect around a 23% return. If Adobe continues to show that they're innovating with AI and the market finally realizes that, we could see it be re-rated, revalued to around a 30 multiple, and that's 28% returns at today's current price. Now, if you think that's too bullish, let's come up with a scenario where they actually are being disrupted by AI. Let's say EPS only grows at about a 10% pace, and let's say the market rates this around a 25 PE ratio. Even with very bearish assumptions, they would still give you a positive gain over the next 5 years. You'd still get a 6.5% return. The point is, this company has just become so undervalued, so sold off for reasons that don't make sense once you realize what the company is and who their customers are. Now, I have so many videos going over Adobe, going more in depth. I have one that's 26 minutes long, so I'm gonna put that in this corner right here for you to click on that. But Adobe is my first stock and one of my strongest buys today. Now, my second stock to buy this month is Uber. Uber's another interesting one because they face threats not from AI, but from autonomous vehicles. Now, last year, they had pretty solid returns, about 19%. But when we zoom that out, over the past 2 years, the stock price hasn't done too much. Since February of 2024, it is around flat. Around the middle of February, it was at $81 a share, and today it's below that. So since autonomous vehicles have become more popular over the past 2 years, the stock price really hasn't returned much. Now, when we look at revenue, they had a dip in 2020. That was from COVID. Obviously, people weren't riding around as much. But since then, they've reaccelerated, and last year grew at 18%. They now have 189 million monthly active platform users. And if we're looking last quarter on a trailing 12-month basis, they completed over 12.8 billion trips. That is like 1.5 trips per every single person on Earth. Not to mention, they have over 36 million Uber One subscribers. Now, like I mentioned with Uber, the number one threat right now is autonomous vehicles. You would think with all the different autonomous vehicle opportunities out there, like a Google, Amazon, NVIDIA has their own, there's multiple different companies. Eventually, these are the robo-taxis gonna go around driving you to where you need to be rather than human drivers. It seems like a safer and easier alternative. Now, people wanna bring up AVs taking over, but there is one main problem that is going to be so hard to solve with autonomous vehicles alone that Uber can solve so easily because they're so asset light. They don't own the drivers, they don't own the cars, and that main problem is a ride-sharing demand is so insanely variable throughout the entire week. So what I mean by that is Uber highlights on a Tuesday morning, the demand for an Uber is so incredibly low. But when you compare that to the peak of the week, a Friday night, the difference between that is up to 95% different in supply and demand. They also compare different cities throughout different times of the year. So for city A, you have some peaks, like there's a peak in March, there's a peak in May, there's a big dip in June. It kind of ramps back up in September and October. December's a huge one, and then it plummets towards the end of December. So not only is the demand for rides so different day to day, Tuesday morning it's so low, and Friday night it's so high, but also the times a year for different cities matter so much. Okay, so now imagine you're an AV company and you have your parking lot full of autonomous vehicles. These are all the cars sitting around waiting to be used. On that Tuesday morning, that parking lot is full. Those cars are sitting around, not being used at all. They're wasting around, wasting capital. And then we go to a Friday night. And all of a sudden, every single one of those cars needs to get out. And even then, you might not have enough cars unless you have a bulk of cars. Then you still have some cars just sitting around doing nothing. Then let's compare that to cities. At the start of December, you need all your cars out almost all the time. Demand is high, so your supply needs to be out there. But then just a few weeks later, that drops rapidly to the lowest point of the entire year, and all your cars are sitting around on average doing nothing. You also compare that demand to another city. For city B, March and December is by far the busiest times, but October hits a huge dip. So AVs run into a number of problems with supply and demand. This is where as an Uber, on a Friday night when more drivers are needed, you raise the incentives, you raise the pay, and more people go out and start giving rides. And then on a Tuesday morning, nothing's really needed. Less people are going out, just enough to actually get the job done. They have mastered the supply and demand aspect of this. AVs can't do this. So what are they gonna do? Obviously, autonomous vehicle companies had to have thought of this. So what Uber is starting to do is have a hybrid method. So let's say in a city, Uber will have a fixed amount of supply for AVs. Let's use this line right here. That means they could cover all of these low dips right here, but don't have enough for the peaks. That's where the hybrid comes in. That's where humans come in and fill the demand when the demand is higher than their actual supply. Now, autonomous vehicles realize this, and they realize that Uber is almost a demand aggregator. They're the ones that have figured out the demand, and we could work with Uber to solve this problem. So you have AV companies partner up with Uber. You have companies like Waymo, WeRide, Pony AI. NVIDIA is also a big one that's recently came in. So autonomous vehicle companies realize it's going to be so hard to compete with Uber because of the way supply and demand is structured in the ride sharing industry. What's cool too is Uber has started to see that the amount of revenue per vehicle they're making with autonomous vehicles are larger than when those autonomous vehicles aren't partnered with Uber. So it's actually becoming a big plus when these AVs are with Uber. So the number one threat, the number one reason why Uber has been pretty flat over the past 2 years and now trades at a 17:4 PE ratio is because of a threat that doesn't totally make sense. AVs are not going to take over Uber. They are going to partner with Uber, and Uber is going to become the main demand aggregator for them. Uber has figured out all the supply and demand problems in each and every city with decades of data. Now, for my price prediction, I think free cash flow per share is going to grow around a 20% pace conservatively for the next at least 5 years. If we're looking for a free cash flow multiple, I think anywhere around a 20 is fair. I think you could go up to maybe even a 25, but for this prediction, let's say 20. That means over the next 5 years from this pace right here, Uber is going to grow around 21% year over year. This is another company I really like at the current prices, and it's the second stock. Now, stock number 3 is one that doesn't need much of an introduction, and it's Amazon. It is no secret that over the past 5 years, Amazon has completely lagged. When you compare it to big tech competitors like Meta, like Google, NVIDIA, over the past 5 years, it has just underperformed. Now, a lot of questions I get, and a lot of people see this lagging performance and start to question, are they gonna be able to fix it? Are they going to be able to speed up and keep up with other big tech companies? Now, obviously, if it's on this list, I truly believe so. But there's one major reason why I think this company is a very strong buy right now, and is actually my largest holding. So when we look at revenue per segment, so much of their money comes from e-commerce. E-commerce is famously an incredibly low margin business. That's why Amazon was barely profitable, if even profitable, until they introduced AWS, their cloud computing. Now, why am I bringing this up? Because the possibility of margin expansion in this area. With the addition of both AI and robotics, Amazon is going to have the opportunity, and they're already starting to do so, in the case that they're going to become so much more efficient that margins are going to expand rapidly, and e-commerce for them is no longer going to be this low margin business. It's going to be this business that starts generating more and more revenue to the point where we're going to start seeing them make over $1 trillion in a single year, which would just be incredible. Now, I've talked about it before, how they have over 1 million robots inside of fulfillment centers, making everything more efficient. But I haven't talked about the white collar part of it, how AI is starting to take away jobs and they're starting to cut jobs. Now, I want to show some points from this article. Amazon accesses 16,000 jobs as it pushes AI and efficiency. So Amazon confirmed 16,000 corporate job cuts on Wednesday, completing a plan for around 30,000 since October, while leaving open the possibility of further reductions. Although 30,000 represents a small portion of Amazon's 1.58 million employees, who are mostly fulfillment centers and warehouses, it is nearly 10% of its corporate workforce and represents the largest job cut in the last 3 decades, surpassing the 27,000 it paired between late 2022 and early 2023. The job cuts also underscore how artificial intelligence is changing corporate workforce dynamics. Significant improvements in AI assistance are helping enterprises execute duties from routine administration tasks to complex coding problems with rapid speed and precision, driving widespread adoption. Now, why are robots and AI much more efficient? Well, they work 24/7. They don't have to clock in, clock out. They don't have to sleep. They don't have lunch breaks. They're not complaining. And most importantly, they're cheaper. You don't have to pay them. So Amazon, e-commerce, the largest part of this business, the largest in the world, is going to start seeing a margin expansion as they cut more jobs and more robots jump into the business. Now, everyone knows about AWS. AWS is the biggest cloud computing service in the world, having over 4 million companies on its service. But e-commerce is the one that is slow growth. It gives you a great base. It brings them hundreds of billions of dollars. But in the coming years, I think in the next 5 to 10 years, we're going to see this become a much more profitable part of the business. And before you know it, Amazon's going to be making over $1 trillion per year. So for my price prediction for Amazon, as they continue to grow revenue, as margins start to expand over time, as AWS growth starts to reaccelerate, I think they're going to reasonably grow EPS around a 20% growth rate. Now, for their multiple, they have historically traded at a very high multiple. I think it's reasonable to say over the next 5+ years, they're going to trade around a 30 to 35 PE multiple. So let's say for this example, they're growing EPS at 20%. They're trading at an EPS multiple of 30. At today's price, that's 17% growth. Now that's lower than the past two companies, but Amazon is one of the biggest companies in the world. There's less inherent risk because of size. They're a company that is always going to be around, and pure threats of taking over the business is a lot lower, is a lot smaller than some of these other companies. Now it could be a little more aggressive. Let's say appropriate EPS multiple is around a 35. That's about 20% growth over the next 5 years, compound annual growth rate. So I think either way, with reasonable expectations, with reasonable assumptions, I think in the next 5 years, Amazon is going to be at least double its stock price. Amazon is stock number 3 and is personally my largest holding. Now the 4th stock on this list is one that recently reported earnings, and it is Meta. Now I recently made a video going over Meta's earnings report, so I'm gonna put that up in the corner for you to watch after this video. But I thought it was a very impressive earnings report, and a lot of that earnings report has to do why they're on this list and why I think they're a buy now. Now this last quarter, Meta came in at just under $60 billion of revenue. That was a big jump from $51 billion the past quarter. And over $58 billion of that comes from advertising. This company has over 3.58 billion people logging onto their platforms daily. That's a scale that is insane. That is almost half the world's population connected to Meta. Now, I think Meta is just an incredible company. One, when you have a scale like that, when you have over 3.5 billion people logging onto either Instagram, WhatsApp, Facebook daily, you have a scale that I don't think many companies, maybe a Google has, but you have a scale that is so hard to replicate. I think this is what makes Meta's moat just so incredibly wide. You have a company that is almost completely immune to competition. No one can easily, and it would take decades of work to gain this level of scale that Meta has gained. Now, something to remember with Meta is their customers aren't really like you and I, just using the app. If you haven't paid Meta anything, you're not really a customer. Their customers are businesses, advertisers, companies looking to place ads on their platform. They're the ones paying Meta, and we're ultimately the customers to the businesses running ads on their platform. Advertising is an incredibly high margin business. For this company, gross margins are over 81%. So they really are, alongside Google, the king of advertising. Advertising is something that will never go away. It is cyclical. You will see times where companies cut costs for advertising, for marketing, and you'll see fluctuations. The thing is, those are temporary. Companies are always going to advertise their products, and the best place to do this is Meta. When you have over 3.5 billion people on the platform, that is an incredible amount of people to sell to. Now, this isn't the problem. This isn't why they're only trading at a 24 PE ratio. People know advertising is a cyclical business. The problem is CapEx. The amount of capital they are pouring into AI infrastructure is absolutely insane. It's now projected over $100 billion for next year, and that just creates a lot of uncertainty. With capital expenditure, people are asking, how much is this going to pay off? How profitable is this going to make this business? When is it going to happen? Will it happen? There's just so many questions, and the market doesn't like uncertainty. That's why you ask yourself, isn't it a good thing that they're spending a lot on AI to build out the infrastructure, to build out the capabilities needed to become a powerhouse company? Yes, it is a good thing, but there's just some uncertainty that comes with it. Now, here's the thing. A lot of people think there's a big question mark about the predictability of the capital expenditure, but there's not. There are signs inside the earnings reports that this is working for them. Now, in their last report on Wednesday, they showed 2 key metrics. The first one is ad impressions, and the second one is average price per ad. Now, what we've seen quarter over quarter across the entire world, ad impressions have gone up. When ad impressions are going up, what that tells you is more and more people are spending time on the app. Not only are they getting more users, but the users going onto the different apps, Instagram, Facebook, WhatsApp, they're seeing more and more ads. They're spending more time on the platform. The second part of this is average price per ad went up. Now, this past year, worldwide, it grew 6%. So when average price per ad is going up, that means companies are willing to spend more per ad on Meta because it's working. It's driving people to go to their websites and buy products. So this is the double whammy. Not only do you have more people spending more time on the app, you also have these companies willing to spend more per ad to be on Meta. Why is this happening? Because Meta's AI-driven recommendations are starting to work in full force. The money Meta is pouring into AI is helping my feed, your feed, be much more personalized. You're starting to see the content you really want to see. You're seeing the ads you want to see, the ads you're more likely to buy, and that's just creating overall value for both sides. Now, again, if you want to hear a little more about this, my last video was Meta's Q4 earnings report results. So I already put that up in the corner, but you could click my channel and find that video, but I want to give my price prediction as well. So YouTuber Joseph Carlson laid this out. Right now, their free cash flow per share is about $18.29. But that's a little skewed because of CapEx right now. So much of that free cash flow money is going into investments, making it lower than it actually is. When you look at operating free cash flow, that number is closer to a 25%. So for these assumptions, I want to use free cash flow per share around $25. Now I think free cash flow for this business is going to grow around a 25% pace. And for the free cash flow multiple, I'm going to have it at 25 as well. So at today's price, with these assumptions, you could expect around a 21% return year over year for Meta. Now, if you want to be a little more conservative, let's say free cash flow grows at a 20% rate year over year, that's still a 16.7 return for the next 5 years, year over year. So I think this company continues to get more attractive, and people are looking at the massive CapEx the wrong way. It's starting to pay off. There's less unpredictability than people think, and that's why I have this as my 4th stock for February. Now, my 5th stock this month is one that has been absolutely hated, and it is Duolingo. Now, if you're a subscriber of mine, you know I own Duolingo, and I've talked about it a lot. This stock year to date is already down over 24%. Over the past 6 months, down 60%. And we're talking about from all-time highs, it is down even more. This company IPO'd back in 2021, and it's now negative. It's now down over 3.5% from that moment. Now, you would think looking at that price chart, oh, the company's completely dead. There's no way they're growing fast at all. They have to be losing users. So let's see, is that the case? Well, revenue last year grew 40% and is almost at $1 billion now. What's best about this is 800 million of that comes from subscription revenue, and that grew over 46% this past year. Daily active users hit 50 million. Monthly active users hit 135 million. They have over 11 million and a half paid subscribers, and free cash flow is at 354 million, growing 55% year over year. This company used to be at a $20 billion market cap. Now it's at a $6 billion market cap. Now, when you want to look at valuation, don't look at trailing because they had a one-time tax benefit, but forward looking, for a company growing over 40% revenue year over year, 25% is incredibly cheap. And for a small company too, valuation could get compressed super fast. Now, just like with Adobe, I've talked about Duolingo so much. I have so many YouTube videos over them. So I'm gonna put my favorite one up in this box for you to learn. But there are a few things I wanna cover. The first one is their most recent drop. So you can see coming down from all-time highs, they were at over $500 a share, and it dropped. Now I could justify this drop. This stock was trading at an over 200 price to earnings ratio, which for almost any company at all is just unjustifiable. So I'm good with that. I'm good with the initial drop. I was not buying here. But then this second drop, dropping from $260 a share to under $200 a share to at one point 168, and now all the way down to $134. I think that drop was unjustifiable. This initial drop right here happened after the earnings report. This is the same earnings report that showed 40% growth year over year for revenue, the same one that showed daily active users was over 50 million, the same one that showed monthly active users was 135 million. Everything in this report looked great, but there was one thing inside the earnings report that made investors worry. It's this right here, the booking forecast for Q4. So they forecasted around this number right here, which is under expectations. So all of a sudden, you see this growth company, a company growing revenue 40% year over year, a company that has a high valuation, one that's trading at a premium because of the rapid growth, they're starting to slow down. Oh no, this company isn't worth a high multiple anymore. We need to sell it off. Now, people looked at that and panicked. What they didn't look at is why. Why were they estimating less? The number one thing is from the CEO. He mentioned they are taking the long view. So what they see is they see the opportunity ahead of us to teach billions of people. And while we've made incredible progress on this, we know we're early in the journey. What they did last quarter is shift towards the long term. They said in particular, we're investing proportionally more in teaching better, and we're prioritizing user growth over monetization and A/B tests that get launched. This shift is reflected in our full year guidance. We're doing this now because we want to keep growing users for a long time, and because our increasing conviction that AI can fundamentally change what's possible in how we teach. If we develop an app that is more engaging than and teaches as well as a personal tutor across multiple subjects, we think we'll become a much bigger business in the long term. That right there, that is the exact statement I want to see as a long-term investor. I want to see the leadership focus not on short-term monetization. Like I said at the start of the video, I don't care about what these stocks do in the next 3 to 6 months. I care about the next 5 to 10 years. I want to see companies focus on the long term, focus on long-term compounding, especially a smaller company like Duolingo that faces competition. So what I got after this earnings report was not only a big stock drop, the stock became significantly cheaper and is almost half the price it was before the earnings report, but I also saw the long-term quality of this business grow. I got exactly what I wanted. There was not one thing I could have taken from this earnings report that made me worry about my investment. So that explains the drop. Now again, I've talked about Duolingo a lot, but there's one main thing I should cover about the actual business. A lot of people think the content side of the business is what matters. They think AI is going to replace the business. I could use ChatGPT, I could use Gemini to learn what I want to learn, to learn languages. Well, first off, talking about the language part of it, they're no longer just teaching languages. They're teaching math, music, and chess. And chess is actually seeing a higher retention rate, seeing more success than language ever saw. So this isn't really just a language learning app anymore. It's starting to become a chess and language learning app. But whatever, that's besides the point I want to make. People think AI is taking over this business. What they don't realize is AI is also helping Duolingo. It took them 12 years to build 100 courses. Last year alone with AI, they built 148 courses in a single year. This is stuff I've covered before. The thing I haven't done as good of a job covering is their advantage isn't content. Anyone can make content. Anyone can make gamified content. It's the decade long of thousands upon thousands of A/B tests teaching Duolingo how exactly to keep people retained and motivated. When you're learning a language, when you're learning chess, these are skills that take years upon years. It doesn't matter if you have the best content in the world, the best tutor ever teaching you. If you're not going to come back and learn each and every day, you're not going to learn. This is where Duolingo wins. They've mastered this through streaks, through leagues, through leaderboards. They now have player versus player in chess. They've mastered this through notifications. But most importantly, they've done this by collecting billions of data points through thousands upon thousands of A/B tests of telling you exactly how to keep you retained. You might be able to do what Duolingo does on ChatGPT in just 10 minutes, but your motivation is going to run out. Here's an example of this. When you first go on Duolingo and you learn something, there's motivation, there's natural motivation. Oh, I just started learning chess. I just started learning Spanish. I'm excited to complete a few lessons each and every day and learn. After about a few weeks, maybe a few months, that motivation truly runs away. You don't really care about learning anymore. What then happens is your motivation goes from actually wanting to learn is, oh, I built up such a long streak. I have so many awards tied into Duolingo. I have so much XP. I have friend streaks. I'm high in my league, that you're not worried about the learning aspect of it. That's not motivating you anymore. What's actually motivating you is all that effort you put in. You're like, dang it, man. I don't want to do a lesson today. I don't want to learn today, but I have to. And that's where learning really happens. Not when you're motivated, because motivation runs out. Motivation is a feeling. Feelings don't last forever. Duolingo has a natural switching system from motivation to you just need to get the work done, because that's what a lot of everything is. I don't always want to make a video, but I have to get that done. You don't always want to do the laundry or the dishes, but you have to get that done. That's how learning is sometimes too. You don't want to do it, but you have to get it done. And Duolingo has found a way to continue to retain people and motivate them to learn over months and years. Now again, I have other videos going in on other aspects of this business, like their data flywheel. They have a reinforcing data flywheel, just more about the AI aspect of it, more about what they do. But this is the number one thing people get wrong. I think this stock has gotten so incredibly cheap. I want to show you where I think this price can be 5 years down the road. So I think for Duolingo, it's reasonable to say that free cash flow per share is going to grow around a 25 to 30% pace over the next 5 years. Remember, this is a smaller company, and they grew about 55% free cash flow last year, and over the past 2 years, it was 83% year over year. Now, this number is going to keep getting smaller by the law of big numbers, so let's stick with 25. Now, for a free cash flow yield, I think they're going to be around a 4.5. So from today's prices, I think they're going to grow above 30% each and every year, to the point where in 5 years, they're going to be around $519 a share, which is actually lower than their all-time highs. Now, I think their all-time highs were unreasonable, like I said, but this is not even a crazy estimate. They're growing free cash flow so incredibly fast, they're growing revenue so fast, and the stock is sold off like this company is completely dead. Now, I don't think this company is dying. I own a lot of Duolingo, and I'm continuing to add on these dips because I don't think it makes sense, and it is why it's my 5th stock this month. Now, for stock number 6, my final stock to buy this month is Netflix. Netflix is a stock that's down over 14% over this past year, but over the past 6 months, down over 27%. Now, this drop first started after they announced they're acquiring Warner Brothers. The stock, when this happened, was at about $110 a share, dropped all the way to $92 per share, and since then, it's continued to fall off down to the low 80s. Now, I'm gonna put my Netflix deep dive up in the corner for you to watch. It's an 18-minute video, so if you wanna learn more after watching this video, I'd go check that out. But Netflix is such a dominant company. So to truly break down Netflix, why I think there's an opportunity, we need to understand that content is a fixed cost business. So what I mean is right now, Netflix spends about $17 billion per year to make content. This number has kind of fluctuated throughout history, but they right now are at $17 billion. That $17 billion needs to be spread out across 325 million users. So that means the more users you can spread that cost out about is the less money it costs for each and every user. So to put this into perspective, comparing it to competitors, so Netflix spends about $52 per user per year. So to compare that to Disney Plus, they have 130 million users, but they spend $26 billion on budget every year. That's about $200 per user per year. You go to Amazon, they have 200 million users, spend $19 billion for content each year. That's about $95 per user per year. You go to Paramount, they only have 79 users, but they spread that out across $15.2 billion content budget. That's $192 per user per year. So it is clear that in this business, scale drives dominance. Scale is a total cost advantage, and because Netflix has the biggest scale, has the most users, the most subscribers, it allows them to do things like buy Warner Brothers. Now, how are they able to satisfy 325 million people with only spending $17 billion per year on budget? This is where pure data collection allows Netflix to win. Netflix is always running hundreds of different A/B tests on their platform. These different A/B tests collect different data, like what you're watching, what you stop watching, when do you pause during a movie, what thumbnail you're most likely to click on. Let's say you watch Stranger Things, what are some other shows you're likely to click on? This allows Netflix to be more personal. It allows them to figure out what actually keeps you on the app, how to really recommend you the right stuff to get better average revenue per user and better lifetime value. This data collection is why they can spend so little and satisfy so many. When they know exactly what their users want to watch, they don't need to risk their budget into shows that aren't going to make sense, into shows that aren't going to be watched. They could be a lot more specific, a lot more personalized, whereas other companies don't have that scale, so they don't have that level of data collection. Now again, I have a full video breaking down Netflix and this incredible cost advantage they have, this incredible competitive advantage they have. So if you want to learn more, watch that. But there's one thing I want to bring up, and how I think this company is almost recession resistant. So whereas a lot of companies are cyclical, Netflix is basically counter-cyclical. So let's say there's a recession. People want to start spending less. Netflix doesn't have a freemium tier, but the cheapest tier they have is an $8 a month tier. This is standard with ads. So we could say someone with the standard tier, someone that just watches Netflix without the ads, cancels and goes down to the $8 a month tier. So someone with the standard tier, Netflix is capped at only making $18 a month from these people, from these subscribers. They don't get any money from ads, they're only making it from subscriptions. With the standard with ads one, they're making $8 a month at a minimum, but they're also making money from ads. So with other businesses, you'll see people just cancel their subscriptions in general. They'll go to the freemium tier, make some money with advertising, but not a lot. With Netflix, when people cancel their subscriptions and go with the cheapest option, it's not freemium, it's a cheap option with advertising, Netflix will start making more money from ads. So they're not thinking, oh, we went from making $18 a month from this person to $8. They're thinking, oh, we lost $10 of guaranteed revenue. But in reality, with the amount of ads this person is gonna watch, we're probably making more. So Netflix is a company that actually benefits from recessions, actually benefits from a weak economy. So overall, I think that's a factor to consider when buying this company. Even during the hardest economic times where most companies do very poorly, most stocks drop off, Netflix is one that is actually probably going to benefit from it. Now let's end this video off giving my price prediction for Netflix. So I think over the next 5+ years, Netflix is going to grow their earnings per share around an 18 to 23% rate. For this assumption, I'm gonna go with they're gonna grow at 20%. Netflix is also a company that is traded like a big tech company. They have always traded at a high multiple. A good historical average for this company, they've traded around a 35 to 45 price to earnings ratio. For this estimate, I'm gonna put it at 35%. That means from today's price, you could expect them to grow around a 21% rate year over year. In 5 years, you could expect the stock to be around $220 per share. Netflix is another stock I've fallen in love with, especially with this Warner Brothers deals, as they're going to gain an entire library of elite content, amazing content. I don't think this Warner Brothers deals is a negative at all. I think it's a great addition to the company, and I think it's a great opportunity that is being sold off for this reason that I think is very positive. Now, Netflix is my 6th stock and final stock that I like for this month. Okay, so those are my 6 stocks that I like for the month of February in 2026. Now, if you are a returning subscriber, I'm in a new setup. I'm back at school, so I wanted to kind of organize this corner to make it a cool, nice area to record in. I'd love any feedback on it. If you think I should add anything, take away anything, Whatever you guys have, I'd love to hear it. Again, this is never financial advice. I'm not a licensed financial advisor. You should always do your own research before buying a stock. Now, to end this video off, I want to say thank you for watching. I appreciate any support you drop on this video, any likes, comments, subscriptions. All of it helps me greatly. Your support over this past year or this past 9 months of me starting this journey has been incredible. It's been far greater than I could have ever expected, and I'm excited to continue to push out content for you guys. With that being said, thanks for watching, and I'll see you in the next one.